Welcome to the Dealmakers Coffee Break. I'm Asaf Raz. Let's go. Welcome to another episode of the Dealmakers Coffee Break edition. So this is Marc Hershberg. He's the managing partner and CEO of Topaz Capital and general partner in Topaz Ventures. Please take it away. I'm not going to talk too much. Tell us about yourself, your history, what you're doing today, and we'll continue the conversation from there.
Sure. So first of all, thank you for having me. Really, it goes way back with you guys to meeting Bar. 2+ years ago now? Through all my buddies in New York real estate, and I can just tell you, it left an impression on me, and it left an impression on many of us in the industry. So it's amazing to see how far you guys have gone, and to see that my alma mater, Marc A Ventures, is involved with you guys, and a lot of folks in the industry. So it's really nice just to see a lot of close friends and individuals involved. So, with that said, I would love to talk a little bit about what's going on today. I mean, we're seeing, I don't want to, over saturate the insurance conversations, because that's really unique to the Southeast, and this podcast is more wholesome than that. And yet, I do want to touch on, what could happen, right? So, what we're looking at right now is an environment where our more sophisticated family offices are saying, hey, we want to keep some dry powder for opportunities that are more devalued than it is today. And, there's, and then we have other, sophisticated investors and family offices and institutions that are saying, well, that's actually not quite our plan. We want to deploy capital, but we're going to deploy it a little bit on the credit side. So there's been a credit shift where people are saying, okay, I want to step into a senior position. So we've seen a very large shift from equity to debt amongst investors, not necessarily ours personally, for the lion's share, but across the space, across the industry. So that's been an interesting shift, going to debt when equity seems few and far between in terms of deal flow and in terms of, deals that could pencil. Now, what I do think is happening is that the feathers are, the trees are starting to, kind of shake shake some of the leaves off the tree, if you will. We're starting to see a little bit of, the guys that are holding on for as long as they could have are now finally saying, well, you know what, my time is running out. My time is elapsing, right? So there's only so much more, whether it's pretend and extend, or extend and extend and forgive, if you will. All those approaches are really not so much applicable to those individuals that have stepped into position now where they are seeing not only their interest rates hard to take out their financing, they're also seeing it hard to sell their asset, because selling today's environment in a buyer's market is very difficult. Not to say that you don't get lucky and you don't get, really good buyers for certain assets in certain locations where people are more aggressive and find the right buyer with a very peculiar need. What I am saying is rather that there is an overarching sentiment in the market whereby if you're able to hold, you hold. And if you're not, sell right away, because we don't think it's going to get so much rosier in the near future. We think rates will kind of stay in this 5+% range. We don't know exactly where, but we do, to quote Jamie Dimon, he really spoke really well in that, it's plausible that we do stay in a higher, quote unquote, high interest rate environment. Historically speaking,
it's environment. It's where it should be, kind of, right?
Right. And if you look at a 100-year historical average, I was looking at this fantastic chart yesterday, very, very fascinating chart, and it was showing 100-year averages at 6.5. So even the average, we're still below the average by 175 bips, according to the agencies. I'm talking Fannie Freddie. You're talking about 5 3/4, 5.8, 5.9 on all in rates, with a 180, 190 spread, right? So you're seeing this, you're seeing rates still be within, call it tighter rather, tighter than the historical 100-year average. Now, with that said, obviously the economy, we all know, right? The economy here is definitely stronger and more sophisticated. The banking systems are more sophisticated than they were 100 years ago, right? So, or at least we hope so, right? Because if not, it's a little bit of
it's gonna be a mess. It's gonna be a big mess.
Exactly, or it's a really tough pill to swallow. Where now would Armageddon, but it would definitely be a mess to say the least. So that's really fascinating. I think we're going to see how that kind of shakes out. I think another element of what we're seeing in today's market is a lot of people are just, they're scared to buy something and then find out that 6 months later there's been a devaluation on that asset by another 5-10%. However, what I tell most folks is if you're not in the short game and you're in the long game and you have a long-term outlook and you understand the macros, fundamentals to the business, what is a 5% devaluation really mean for that individual in a 7-year period or a 10-year hold period
and it could be a 7-10 year hold period on a cash flowing deal that makes positive ROI, right? Throughout the investment cycle. And the devaluation doesn't really mean a lot until you get to the exit, right? And even then, like if you're holding it for 10 years, it's probably going to go back, right?
Right, exactly. And to your point, what I also interested to hear is like, if you're in a position where you have a 5% devaluation now, but your appreciation is baking in an exit dispo cap, I don't know, 6%, let's just say disposition cap rate, right? Then really, what does that really mean if the market's at 5 then, or it's at 4.5 again, or it was at 3% like it was 2 years ago, right? So that type of climate kind of inch back, these 5%, shifts in valuations are not going to make a world of a difference.
Yeah.
You're going to recapture it on the back end, A. And B, to your point, it's going to be cash flowing at least, let's say you go 1 year of negative leverage. Okay, fine. So 1 year you don't have positive leverage. You're not seeing good, strong cash flow. But after that, you should be able to see a very gradual, healthy cash flow stream.
I agree.
That's something that, I think we're trying to remind a lot of our investors. We're trying to remind a lot of our partners. And our partners are telling us that this is the conversations they're having with their investors as well.
What are you doing right now in terms of your investment strategy? How is it maybe unique or different than what you've used to do when looking in current market, current market trend?
It's a great question. Yeah, so we're primarily a multifamily household name, if you will, in Florida. We're definitely focused. We're Southeast guys. We're focused on the Southeast. It's what we live, breathe, and know, right? So we're very much very, very much concentrated on, okay, how does multifamily going to fare in the next 6 to 12 months, and how is our pre-existing portfolio, everything we have right now, how is that faring as well, right? So that's that. There's a lot of pain on the asset management side that we've been very fortunate to have a strong team on to address a lot of the challenges, or if you want to call them headwinds, that we stepped into over the last year, with interest rates ticking up, with operating expenses ticking up, with gross income coming down because rental rate softening is a nationwide, conversation and trend we're seeing. So that's been something we've been really, focusing on. Now, we've been fortunate to have less of a need to stay on the pulse of every, hourly decisions, if you will, on the asset management side. We've kind of stepped out of that because we're seeing, we feel like we can't say we're meeting a ceiling because we have no idea how much more OpEx could go up, operating expenses can go up. But what we have seen is that we're above we're underwriting $10,000 a unit in expenses right now in Florida. And just to give you an idea, sense of perspective, this time a year ago or a year and a half ago, we were underwriting $7,000. 2 years ago, it was closer to $6,000. So, we're seeing a major uptick and one could call it a run up of operating expenses of almost 2x in the last 2.5 to 3 years if you're operating in the southeastern United States. So that's something that, obviously, requires a lot of attention and requires, creative solutions, which, I know you mentioned, not talking about anything other than what our primary focus is, which is our primary focus, but we do invest in some prop tech, and the primary reason is to be strategic so that we can use the property technologies for our benefit, for our own portfolio's benefit.
In order to keep within my 15-20 minute rule so that the episodes are catchy and it's easy for people to listen, I'm going to go directly into something I call the shameless plug. And the shameless plug is your opportunity to shamelessly plug in what you're doing with Topaz today. If you're looking for something, what you're looking for, if you have new investment opportunities, you can share with the audience, give them your contact info, website, whatever that is. Please do it shamelessly.
Where the opportunity is now and why I think, we're in a great position is that, predominantly we don't have a lot of exposure to bridge, right? So we don't have a lot of exposure to floating interest rate, adjustable rate mortgages. That's maybe sub 15% of our portfolio. And at which time we're currently refinancing one of those few assets that we currently have on bridge debt, if you will, quote unquote. So from our perspective, we're very happy because we're not so subject to the volatility of the current market. And we're also taking chips off the table in terms of risk chips is what I call them, risk chips off the table. And that's primarily due to the fact that we are going perm on our deals, and we rather return a little bit less money today for a longer term hold anyways, because we're staying in these deals for another 5 years or 4 or 5 years plus with our investors. That's their desire. So take a little bit of the risk chips off the table in order to have a greater longevity and be able to also tell you and your investors, us and our investors in our case, sleep better at night. So that's something that's really exciting for us in terms of what we're seeing in the market. I think there still is an opportunity for guys to step into perm situations, convert their adjustable rates to perm. I think there's going to be a nice amount of opportunity for new construction developers that took in 80%, construction loans, or 80%, rehab and 80% acquisition loans. I'm not saying it's not recoverable story, but they're going to have to layer in some solutions, some alternative capital into the mix. We call it gap financing at Topaz. Shout out to Topaz Gap Financing and our team here, because we do some great mezz and pref dollars that we put out for fellow sponsors in Florida that against multifamily, 80, 85 or newer assets. So our position has been, we're willing to invest and deploy, debt dollars as well as equity dollars, equity being our main business of buying assets. What we're doing now is we're buying newer product to stay away from these issues of higher operating expenses, more fixed expenses instead of variable wild card expenses. You usually have that with older vintage product. And then at the same time, what we're also doing, which I think is, credit goes to our investment committee and our advisors at Topaz, which is we're now saying to ourselves, okay, what happens if rents, come down 15% in the short term or 20% in the short term? Are we still at a good coverage? And also at the same time, not only are we sensitizing all of our models in terms of cash flow, in terms of disposition cap rates, in terms of, in terms of our refinance down the road. What we are doing also is we're saying to ourselves, hey, we need to buy at a good price per pound vis-a-vis replacement cost. Because in a market like today, there's the deal volumes down almost 80% according to NMHC. I saw 75% according to Berkadia's report that they shared recently. So there's a massive drop in deal volume. Now, at the same time, that deal volume means lack of drop. The drop in deal volume also means, equates to rather less competition. And what we thrive off of is less competition in certain areas. And so we think there's going to be a good opportunity now, not only to continue deploying for, like I said earlier, those high octane, value add guys that failed to execute or just didn't execute in time, and or the construction borrowers that have already, done the hard part, already succeeded through the hard part of the project. They're already, vertical on the development. And so they need a $5 million, $8 million, whatever it is, several $1,000,000 to help them get to the first CO that they need in order to get real value. And that's something that's been critically important for us, is to not only buy good deals, and be there for our brokerage relationships, and our types of servicing relationships, but it's also been important to be there for our fellow sponsors in Florida and say, hey, if you want to borrow our money, we're going to try to be more competitive than your mezz and pref lender out there, because we understand your position better. We're in your position. We get it. So that's something we're doing quite a bit as of the last 6 plus or minus months. Mm-hmm. But I would still say our singular focus, our primary focus rather, is to get the lower bases, primer located assets, newer vintage, and, pick those up at, let's call it 20, 30% less than what they were valued at 6, 8, 12 months ago. And, take a good position in those deals. We're trying not to go negative leverage day one in today's environment. However, there are some deals that make sense. You get the right price per pound and you get the right narrative and location of the asset. It really is worth, and rents are really low and suppressed for whatever reason. It makes sense many times to just step into that position with negative leverage for a year or less than a year or 2 years. And it's not uncommon, right? So that's something that people have to remember, is just because everyone's solving for positive leverage day one doesn't mean that negative leverage day one is going to be an epic failure, because it's not. It's all it's a more dynamic situation than that. And so that's what we're seeing on our end. And we're excited. What we pride ourselves on is that we are really all about our reputation. And so when we go out there, we're dealing with brokers, we're dealing with, investors, we're dealing with our servicers across the spectrum, whether it's title, insurance, and otherwise. We really take it upon ourselves to make them feel like our family, part of the Topaz family. Mm-hmm. We say that to our employees, to our partners, and the reason is because the more they feel like a sense of family, the more they feel like they're part of something, the more you're going to think about them, and the more you're thinking about them with sincerity. And so that's something we're trying to do in today's environment that a lot of other shops are not doing. We're also, candidly, honing in on the relationships that we're closest with. And we're saying, okay, let's go to bat together. Let's go after deals, and let's take a sharpshooter tactic. Because in this environment, for the first time in a long time,
14 years, by the way. It's 14.
Almost over 14 years, right? So seeing that you could actually now say, hey, broker's not so busy, where he's saying, oh, I'm busy all day long. I have 100 CAs signed, 50 tours by tomorrow, and they're all inundated. I'm not saying the best brokers aren't still busy. They are. I'm talking to them, and a lot of them are still busy. What I am saying is that they have more time on their hands to help you solve for your strategy. Mm-hmm. So go to them, and they know you, and they've closed with you, and they understand how you do work, and they want to continue working with you. It's not so far-fetched to ask them, hey, here's a list of properties that I want to target. I think I could get aggressive on for these X and Y, Z reasons. I think they're going to be willing to sell. And so that's something we've done now that we haven't done before, candidly. And we've tried it before. We've tested the market with it. We tested the brokers with it. And it wasn't successful because they were so preoccupied by just making money and listing deals. And for the first time in a long time, we are seeing them finally become more amenable to the fact that there has to be more proactive sourcing with your best clients, with your best buyers, or call it natural, the guys who want to work with natural buyers. and work with them to see what types of deals you could take down. And so that's been really, really exciting for us. Is the more sharp. So yeah, no, I appreciate everyone listening in, and I would love it if you guys could reach out. I'm always available to have a conversation. You can reach out to me at marc@topazcg.com, MARC@Topaz, TOPAZ, CG as in capital group.com, as well as at Topaz Capital on Instagram, Facebook, and then on LinkedIn, we're at Topaz Capital Group. Please follow us on all the mediums. We share relevant data. Also, if you go to our website and subscribe, throw in your email there to the subscription of our e-newsletter, you're going to receive not only important quarterly e-newsletters about the industry, you will also receive insight and research reports that we provide, we publish. And so we encourage you to reach out, to subscribe, and anyone who has any questions, we're always available.
I love it. Marc Hersberg, thank you so much for joining me for another episode of The Deal Makers. I really appreciate it.
Thank you so much, Asaf. It's my pleasure. I really appreciate the time.
Thank you for joining us. Check out more episodes on the Deal Makers podcast, available on Spotify, Apple Music, Google Podcasts, and Agora's website at agorareal.com/podcast. See you in the next episode.